Okay, some Chapter 9 things we've got here. Chapter 9, a couple exercises from the book we're going to go through. We're looking at notes here in payroll. And the first one here is exercise 9.4 from the text. It has an interest-bearing note payable with year-end adjustments to have here. So, Keisha Company borrowed $200,000 cash on November 1st of the current year by signing a 90-day, 9% $200,000 note. They ask what date does the note mature, how much interest expense in the current year, how much in the following year. I hate to give you the answers, but that's for you to check it. And then to do journal entries here. So, for the first part of this, on what date does the note mature? The way I like to think about this, and this is going to sound weird, but it's always stuck with me. If this note was taken out on November 1st and it's a 90-day note, technically, we would see this note maturing on November 91st. And I know that sounds weird, but bear with me. So you think, okay, if we start this in November, how many days do we have in November? Well, we have 30. Right? So looking at this, we could say, okay, after the end of November, we have 61 days left. So what about December? Well, we have 31 days in December. So, if we look at it and say, after this, what do we have left? Well, we have 30 days left. So January, if we do 30 days out of January, that means we're looking at 0, which means this note matures on January 30th. So for number 1, January 30th is our answer. And we'll just put that there. Number 2 says how much interest expense is recorded in the current year. Well, for number 2, if we look at this and it tells us to assume a 360-day year, you have to remember interest is equal to principal times rate times time. So in this case, what we're looking at here, we've got our interest is going to be equal to the principal, which is $200,000. And our interest rate is, they give it to us a 9% note times 0.09. And then, if we think about this, this was done on November 1st. So how many days do we have left in the current year? Well, we would have 30 in November, and then also, the 29 in November, because this was done on the 1st. We would have the 29 in November remaining, and then also we would have the 31 in December. So this would be 60 days. So we would have 60 divided by 360, which means we're looking at $3,000 is our interest expense for the current year. Now, what's our interest expense in the following year? Well, if we think about this, how many days do we have left in the year? Well, we have 30 days left in this new period. So this would be equal to the principal of 200,000 multiplied by, again, the rate of 0.9%, multiplied by, now this time we have 30 days in December, and we're basing this off of 360 days in the year. So we would be looking at having $1,500 interest expense for the second year. And then number 4 says prepare journal entries to record the issuance of the note. We'll do 4A. Okay, so 4A, the issuance of the note, and this is probably, we should do a date here. And we'll just do it right here. So we did this on November 1st, so 11/1, November 1st. What we're going to end up having here, we borrowed this, so we would have cash. We would receive 200,000, and then this is a note payable for 200,000. So there's our entry for when we get the note. That's the issuance. The accrual of interest on December 31st. So this one we would have 12/31. And remember, we calculated $3,000 of interest here. So we would have an interest expense for the portion of the current year of $3,000. And we're not paying this yet. We won't pay this until maturity comes. So this is interest payable, meaning we owe this money. So that's our entry for the end of the year. And then the last one they say is payment of the note at maturity. So for that, we're looking at January 30th of the next year. And we have, first of all, we have to think about this. We have to get rid of our note payable. So we'll debit our notes payable for the $200,000. We have interest payable. We need to debit that. We need to debit that as well for the $3,000. And then this period's interest, we calculated number 3 is $1,500. This is interest expense because this is in the current period, and that's $1,500. So when we look at these, when we pay this back, of course we have to pay cash, and it's going to be the total we have here, which is $204,500. So journalizing these, we're doing that. But remember, interest is equal to principal, INCIP, principal multiplied by interest multiplied by time, or not interest rate, I should say, principal times rate times time. So this is the key thing we're looking at here. Okay, so that's how we do a interest-bearing note payable. Now the next example we're looking at, we're going to be dealing with payroll here. Now with payroll, there's a couple different things we need to think of, but most of it is given to us. So BMX company has one employee, FICA, which is Federal Insurance Contribution Act. FICA Social Security taxes are 6.2% of the first $128,400 paid to employees, and FICA Medicare taxes are 1.45% of gross pay. Meaning, if you make over once you hit that $128,400, you no longer pay the 6.2% into Social Security in a year. For BMX, it's FUTA, or Federal Employment Tax, are 0.6%, and SUTA, which is the State Unemployment Tax Act, is 5.4% of the first $7,000 paid to employees. So once an employer earns $7,000, no longer does the employer have to pay the federal and state unemployment taxes. So we want to compute the amounts for each of these 4 taxes as applied to the employee's gross earnings for September under each of the 3 separate situations, A, B, and C. So in A, we have the gross pay for September. We have their pay through August. So we're going to be adding these, see if they hit any of these thresholds and what we're looking at here. So in 9.5, we have A, B, and C. How do I want to set this up? We'll do this shortly. We would have, let's see, 4 taxes. We have FICA. Let me adjust the column width here. We will have FICA Social Security. Get out of here. FICA Social Security. We will have FICA Medicare. We will have FUTA, Federal Unemployment, and SUTA, State Unemployment. And then we'll have, we'll have for A, B, and C. Now, when we're calculating these, it's not too difficult. So we look at this for A. We have A has made $6,400 through August 31st. Their gross pay is $800 for September. Social Security, that means for September they're going to be at $7,200. It doesn't matter for Social Security. They're far away from the $128,400. So their Social Security tax is going to be equal to the $800 they get this period, multiplied by the 0.062 for 6.2%. So they'll be looking at, we can make these into dollar amounts. So $49.60. Now for Medicare, in this case, Medicare is 1.45% of gross pay. Doesn't matter. So the pay that's subject, they made $800. So this is going to be equal to the $800 multiplied by the 0.0145. the decimal equivalent for 1.45%. So for A, their FICA Medicare is $11.60. Now, for federal unemployment, this individual made $6,400 through August 31st. So even though they made $800 in September, the cap on these is at $7,000. So only $600 of each of these is applicable for FUTA and SUTA taxes. So in this case, we will have the SUTA taxes would be $600 because only $600 are applicable of the 0.006%, which would be $3.60. And then SUTA again is the 600, remember, because that's puts them at the threshold of the $7,000, is 0.054. So that means they have $32.40. So that's A. So for B, B made $2,000 through August 31st. They get $2,100 in September. That gives them $4,100 total. Nowhere will they be hit a threshold because they're far enough away from 7,000 and they're really far away from 128.4. So in B's case, the 2,100 they get for September, all of that will be applicable to taxes. So here we're looking at 2,100 multiplied by, this is Social Security, which is 0.062, or the decimal equivalent for 6.2%. So we'll be looking at 130.20 for Social Security. Medicare, is, again, they're 2,100 times 0.0145. We'll be looking at 30.45. Federal unemployment is their 2,100 multiply 0.006, $12.60. And for their state unemployment, it'd be 2,100 times 0.054, 5.4% for 113.40. Now for C. C has made $122,100 through August 31st. The gross pay for September is $8,000. That puts them above the Social Security threshold, and also they have passed the threshold for FUTA and SUTA a long time ago, so they'd be at 0 for them. Now, Social Security, the limit on that is $128,400. They have paid, they've received through August 31st 122.1. So really, only 6,300 of this 8,000 is subject to the federal Social Security tax. So basically, we're looking at equals 6,300 is applicable times the 0.062. So we're looking at $390.60 for Social Security here. And for Medicare, it's just your full pay there. There's not a cap on this. It's 8,000 times your 0.0145. So for C, we have 116 is their Medicare. So that's how we calculate the tax. So what we've got to be careful for here are these thresholds. Now, 9.6 is the next one, and these are all related. This is why I put these ones together. 9.6 is to use the data in situation A, and A was here. This is A. We'll just highlight that so we know that's A. Of exercise 9.5, prepare the employer September 30th journal entries to record salary expense and its related payroll liabilities for this employee. The employee's federal income taxes withheld by the employer, $80 for this pay period. Round amounts to cents. All right, so as we look at this, let's see, we're going to do some journal entries here. So let's do them over here. We can adjust this column without getting in too much trouble. And we'll put a date and stuff here. September 30th is the date that we're going to need. So we have our 9/30 is our date. Now we need to look at these related journal entries for the employer. So basically for employee A, we have their gross pay for September is $800. That's going to be what we would consider the salaries expense here. Okay, so that'll be 800. Okay. Now, the other parts of this that we had, that these deductions that were taken out of here, these are going to be payable for the employer until such time as they pay them. So really, we will have like a FICA Social Security payable. We will have a FICA Medicare payable. We'll have a FUTA payable. And we'll have a SUTA payable. And these are, remember, liabilities. We'll indent these. So our FICA Social Security, we just take it from up here, is 4960. We have 1160, 360, and 3240. So if we total all these up, let's just do this down here and then we'll get rid of it just so we can see. We get 9720. So essentially what we're looking at here is these are all payable. These are all payable for these. And then we also have to look at, we have the employer's side of this, which we'll get to next. I should back up here because I'm getting ahead of myself. The FUTA and the SUTA come from the employer's side, not the employees. So we can get rid of those. The federal income tax that they tell us, however, that's $80. That does come. So we'd have federal tax payable, and that would be 80. All right. So if we look at this, we see the total of these payables that we have are $141.20. So basically this means that the employer pays the employees Social Security, Medicare, and federal taxes out of the employee's payroll check, and the rest is the net that the employee gets. So this would be salaries payable, and this would be the difference, which is the total of these items is 141.20. So if we subtract that from 800, we get 658.80. So 658.80 will be the salaries payable that we have here. Okay, now this is for the employee. The employer side is what we're doing next in 9.7. Now in 9.7, again, we're going to have the data from, again, they're saying situation A, to do the employer's September 30th journal entries to record their payroll tax expense and related liabilities. This is where we'll see the FUTA and the SUTA. So we'll have 930 here. Now, the thing with the employers is they have to pay the Social Security and Medicare that the employees pay as well. They have to match. So they're going to have a Social Security payable. They're going to have a Medicare payable as well. Also, we're going to have our FUTA and SUTA here. FUTA payable and SUTA payable, because the employer has to pay these items out of their pocket, not from deductions from the employee's payroll or paycheck. So again, we're getting this information from what we found out in 9.5, and here's all the payables that we have. Now, this is state unemployment, federal employment, Medicare, and Social Security. So if we add these items up, we'll do that here. No, we want these. We will see that $97.20 is what we consider payroll tax expense. And this is, let's move it just a bit. This is what the employer has to pay, essentially, like I said, out of their pocket. It's their obligation. So when they do pay these things, we'll see, essentially, they'll be, move this back, I just noticed that. They'll be debiting this FICA Social Security payable for $99.20, the total of $49.60 twice. So they'll be debiting that payable. They'll be debiting the Medicare payable for $23.20. Debiting Fed tax payable for $80, debiting FUTA and SUTA payables for $360 and $32.40 respectively, and then they'll be crediting cash because then when they'll be making that tax deposit, of course, they'll have to submit it through tax. So that's how we look at payroll taxes there in a quick rundown. Now the next one we have is dealing with warranty expense stuff. And in this case, we have Hitsu Company selling a copier. It cost them $4,800. They sold it for $6,000 cash, 2-year parts warranty, customer August 16th, year 1. They expect the warranty cost to be 4% of dollar sales. They record warranty expense and adjusting entry on December 31st. On January 5th, year 2, the copier requires on-site repairs that are completed the same day. Repairs cost $209 for materials taken from the repair parts inventory. These are the only repairs required in year 2 for this copier. So they say, and again, they give you the answers, but we'll go through how we figure this. How much warranty expense does the company report for this copier in year 1? Well, it tells us they expect warranty cost to be 4% of dollar sales and record that warranty expense with adjusting entry on December 31st. So the sale for this copier is $6,000 cash. So if we look at this, we're going to say, okay, $6,000 was the sale amount of the copier, and multiply that by 4%, and we get $240 is the warranty expense that the company will report in year 1. For number 2, how much is the estimated warranty liability for this copier as of December 31st of year 1? Well, in year 1, if we think about this, on January 5th of year 2, they required repairs. So year 1, they didn't require any repairs. Nothing was used. So in year 1, we still are at $240 because nothing has changed. Now, number 3 says, how much is the estimated warranty liability for this copier as of December 31st of year 2? Now, this time we see that we had an instance where in year 2, the copier required on-site repairs, and the repairs cost $209. Well, we had the balance in this account at the end of the last year we just calculated was $240. So if we use 209 of that 240, what's left is the difference between the two. So it's 240 minus 209, which of course is 31. So we would have $31 liability left for this copier if it needed repairs in year 2. And number 4 says to prepare journal entries. To record the copier sale, the adjustment to recognize such, I'm just going to make this bigger so we can have some room to write. The copier sale, the adjustment to recognize the warranty expense on December 31st of year 1, and the repairs that occur on January 5th of year 2. So we sold this on 8/16 of year 1. So 8/16. What we did, we sold this. This was cash. Yeah, $6,000 cash. And this is sales. And we'll just call it sales for $6,000. Now, I'm assuming since they give us our COGS here, we're looking at an instance where this is a perpetual inventory system, so we really ought to look at cost of goods sold here as well. So then they tell us that it's $4,800. Oops. So we would also, remember, credit this to merchandise inventory. $4,800. Okay, so there's the sales side and the inventory side on August 16th. So that's the copier sale. So now we're recognizing, B is recognizing the warranty expense on December 31st. Okay, so we calculated that number 1. That was $240. So what we'd have, just, we could call it copier if we sell different things. Copier, oops, warranty expense, that's the $240, and this would be our estimated warranty, oops, liability. Because since we are offering a warranty on this, if any repairs come within that time frame, we're liable to make them. And then the last one says the repairs that occur on January 5th. Well, it tells us that it's $209 for materials taken from repair parts inventory. So if we had $240 liability here, and the date on this again was January 5th, then basically, and we had 240 in the liability, and we're looking at fulfilling 209 of that, and we know we have to debit that estimated warranty because we, in essence, credited it. liability credited is the normal balance. So when we debit it, we're lessening that liability. And then we take this from repair parts inventory. This would not be the same as merchandise inventory. Don't think that. This is a different thing. This tells us this is from repair parts inventory. So this is A, B, and C. This is how we do warranties here. So this is pretty much chapter 9, the important stuff in a nutshell. I may have some additional things here, I'm not sure, but get this out there so you can catch up on it. Chapter 10 will be coming soon. Have a good night.